Welcome to our proactive tax planning workshop today. Our goal is to provide you with helpful information on your 2020 tax return and proactive planning on your 2021. There's 5 key areas of financial planning, and these are the same we always talk about. The first is preservation planning. The second is retirement planning. The third is tax planning, and that's what today is all about. And then we have estate planning, and one more, the investment planning. So even though we're about tax planning, we still are a comprehensive planning firm. Our proactive tax planning is a key focus when we review your personal financial situation. We're looking for tax saving opportunities and strategies, and this workshop will review some of them, and it will also point out to you some of the potential tax ideas that we have. And we will caution all that not every idea here is appropriate for your personal situation. So each one's a little bit different, and we have to be careful to apply it personally to you. So it's kind of a custom thing. So this is some 2020 tax information, and we'd like to share that. So this is the tax brackets, and we show single, head of household, married filers across the top. And then these rates show the income areas that each person is falling into. The 3 most common methods are shown: single, head of household, married. And remember that due to inflation, the tax brackets are due to change 10%, but there's still a 37% bracket. The standard deduction makes it easy, so you don't have to do a itemization, but that is entirely up to your personal situation. There's state and local taxes are still capped at $10,000 for tax payers who itemize, and that is usually not too much of a problem here in the state of Texas. Long-term capital gains rates, if we had married filers under 80, or they're 0 for your long-term cap gains, under 496, 15%, and over 496, 20. So it's a very favorable tax rate for long-term capital gains, and we hope that that continues. Charitable deductions are still out there if you itemize. There is a new charitable deduction here for $300 if you don't itemize your deductions for 2020. So that is a new benefit. It's called the universal deduction because they want to give incentive for more people to donate to charity. Retirement plans are still in the same approximate areas. If you're under 50, traditional IRA is $6,000, Roth is $6,000, 401k is $19,500, SEP is $57,000, and an individual or solo K is $57,000. If you're over 50, they give you a catch-up provision, so it's $7,000, $26,000, $57,000 for the SEP is the same, but $63,500 for the solo K. These are very good opportunities, and we recommend that everyone take advantage of them to the best of their ability. The next one is some overlooked items and deductions when dividends are reinvested. This is not a tax deduction, but it's a calculation for that's important for your tax purposes. Many have mutual funds and stock dividends that are automatically used to buy extra shares. So each time you reinvest, the advantage is it increases your tax basis for that fund. That will in turn affect capital gains calculation when you sell shares or redeem. Please check that your statements are kept in good order, that you hold on to your records. Forgetting this could double taxation on your dividends because it'll come out as a, rather than a reinvestment, it'll come out as an investment. The next one is carryover items from previous years. This is where we've had losses, so you want to be able to carry those over. And then the new one, the QCD, Qualified Charitable Distribution. If you're over age 70 and a half, you can still do your RMDs from your from your IRA, give it to your charity, and it's zero tax. This is a very strong incentive. The cap on it is $100,000 donation a year, so you can do your RMDs or even more. So if you're in the 70 and a half bracket, you give charitable donations, excellent provision. 2021, now we're looking at some new brackets, and you can see them across the top here. They're similar, and these are the current strategies that the tax brackets are just slightly adjusted. Standard deductions were increased slightly. Long-term capital gains are about the same. There's very little change in those, so there's still very good rates. Contribution limits on retirement plans are similar. Very little change in those. Our catch-up provisions are similar. So don't forget to start your contributions as soon as possible. Annual gift exclusions, or annual exclusion gifts, I got that wrong, are $15,000 this year. So you can gift to a working child or a 529. These are good. You can also donate to a grandchild's IRA. So not just a working child, but a working grandchild IRA. So these are annual gifting. Remember, though, you have contribution limits on IRAs. Here's another one above the line, charitable deduction increase. So the new increase allows, instead of the 300, it goes to 600 for taxpayers filing jointly. That's that little special one I told you about a few slides ago. The 2021 tax projection is something that we should be able to help you with. Why do we want to do a tax projection? It's just good planning. A proactive approach to your planning is better than a reactive approach, because reactive approaches require you to take distributions when you perhaps didn't want to. So there's a couple of things that are listed here. We can use our standard deduction, and then we can do a charitable donation into a donor advised fund, a DAF. And what this does, it bunches your contributions and allows that fund to also direct. The DAF is directed by you and controlled, the investment is controlled by you too. So it's a pretty cool plan. So you bunch your charitable donations together, and instead of giving 1, 2, 3 years or different ways of doing it, you can give to the fund all at once, and then they can donate those out as you see fit. Remember that these are excellent tools, but they're custom. Each person must look at their situation. Here's another little tool we have. When should I convert to a Roth IRA? And you'll note we have two little teeter-totters. The teeter-totter at the top is if you're converting to a Roth IRA and you're at a higher marginal tax rate, then going to the beneficiary isn't really going to benefit you. If you're going to give a partial or full, then the marginal tax rate for you should be less than the one you're giving it to. This is just another little way of looking at Roth conversions. So again, they're customized to each person. The key step is to consider your marginal tax rate and then find out what your beneficiary's tax rate is, and then that will help us with making a wise decision. All right, so there's lots of Roth IRA conversion benefits that overall lowers your taxable income long term. The compounding or growth in your program grows tax free. There are no RMDs, and if you give the money to beneficiaries, and at your death, of course, they can tax-free withdraw from these Roth IRAs. It's a great tool to use. One of them that's overlooked is having your 401k use the Roth contribution, and many companies allow that. So look at that carefully. Qualified charitable distributions that we talked about are a very good strategy for 21 as well. If you're giving to a charity, this is a way to give to them without having to pay the distribution taxes on your IRA distribution. Instead, you just turn it over directly, and there's special forms to do this so that the charity receives it through the third party, the one that's holding the money. Rather than writing a check from your bank account, you write it from your IRA account. And this allows that to go right on out. So what can you expect from us? We're going to regularly communicate with you. We're going to have frequent discussions, as many as you need. Review your economic, tax, estate, and investment issues for all of our clients. We want to help you make your money go as far as you can. And we'd be happy to share this report with anybody that you would like to. We thank you. And remember, your health and well-being is our highest priority. So please take good care of your health, and please continue to do your best, because without health, retirement is not very much fun. We appreciate the opportunity to assist you and your financial needs. And here's our little disclosures.